What if the biggest shift in global wealth didn't happen during a war, a revolution, or a market crash, but quietly, behind closed doors, signed into policy documents no one reads? What if the rules that decide who gets richer, who stays stuck, and who falls behind were rewritten, not by voters or markets, but by institutions designed to be invisible? Most people believe money follows hard work, innovation, or risk. But today's global wealth tells a different story, one shaped by central banks. The mystery isn't whether they change the rules. The mystery is when, how, and why. Almost no one noticed central banks were not always the most powerful economic actors on earth. They began as boring vaults, ledgers, and interest rates. Their job was simple: stabilize currency and prevent chaos. But over the last century, something changed. From the Federal Reserve to the European Central Bank, from the Bank of England to the Bank of Japan, these institutions slowly gained tools that went far beyond stability, tools that could inflate asset prices, reshape debt, and quietly transfer wealth across society. Their twist! They didn't do it all at once. They did it step by step, crisis by crisis each time, claiming there was no alternative. The modern story begins in the early 20th century. Before central banking dominance, money was tied to physical limits: gold, silver, and fixed exchange systems. Governments could overspend, but consequences came quickly. Inflation, currency collapse, or a loss of credibility acted as natural brakes. The creation of modern central banks, especially the Federal Reserve in 1930, was meant to smooth these cycles, lend during panics, tighten during excess. But this power came with a hidden feature: the ability to create money indirectly through credit. At first, this power was restrained. Gold standards and fixed pegs limited how far central banks could go. Wealth still depended largely on production. Then came the turning point: rise power. Through crises, the Great Depression, shattered faith in old limits, central banks were blamed for doing too little. Governments demanded flexibility. Then World War II finished the job. After the war, the Bretton Woods system put central banks at the center of global finance, with the US dollar as the anchor. When that system collapsed in 1971, when the dollar was cut loose from gold, the final constraint disappeared. Now, money could be expanded without a physical limit. At first, central banks promised discipline. But each crisis tested that promise. The 1987 crash, the dot-com bubble, the 2008 financial crisis. Each time, central banks responded the same way: lower rates, inject liquidity, rescue markets. And each time, the side effect grew larger. Cheap money didn't flow evenly. It flowed into assets, stocks, real estate, bonds. Those who owned assets grew wealthier. Those who depended on wages did not. The rules of wealth were quietly changing. Breaking point, when the system exposed itself 2008, was the moment the illusion cracked. Central banks didn't just stabilize markets, they saved them. Quantitative easing created trillions in new money, but not through paychecks or public investment. It entered through financial institutions. Asset prices recovered faster than economies. Stock markets hit record highs, while wages stagnated. Housing became unaffordable. Debt exploded. Then came the pandemic. In whose months, central banks created more money than in decades combined. Again, markets surged. Again, inequality widened. Inflation followed, but not immediately. The delay must, by the time prices rose, the money had already reshaped wealth. The fallout is measurable. Over the last few decades, asset owners captured the majority of wealth gains. Younger generations accumulated debt instead of assets. Governments became addicted to cheap borrowing. Markets stopped pricing risk honestly. Central banks didn't intend to rewrite wealth rules, but their tools made it inevitable. By suppressing interest rates, they punished savers. By inflating assets, they rewarded leverage. By rescuing markets repeatedly, they removed failure from the system. The result? A financial world where survival depends less on productivity and more on proximity to money creation. Central banks now admit the side effects, but claim they're trapped. Raise rates too fast, and debt collapses. Stop intervening, and markets panic. Tighten policy, and governments struggle to function. Every fix creates a new dependency. The rules have been rewritten, but reversing them may be impossible without pain no leader wants to accept. Today, the same logic continues. Digital currencies, emergency lending facilities, balance sheets larger than national economies. The language changes, but the pattern doesn't. Crisis, intervention, asset inflation, inequality, bigger crises. History isn't repeating exactly. It's rhyming louder each time. Here are 3 takeaways. Central banks don't just manage money, they shape who wins and who loses. Wealth today follows access to assets, not effort alone. Every crisis response quietly becomes permanent policy. The warning is simple. Systems built on constant intervention grow fragile, not stable. The open question remains unanswered. What happens when confidence in the rulemakers finally breaks? If you want to understand money beyond headlines, how power, debt, and history intersect, because the most important financial changes are never announced loudly. They happen quietly until it's too late. No file chosen. No file chosen. ChatGPT can make mistakes. Check important in.